$1 million initial threshold of funding on the SunX token sale. We will then begin to allocate some of the additional proceeds of the sale to the SPIF to the extent that as the token proceeds amounts grow, the SPIF will be up to 20% of the total amounts of funds raised. The SunX tokens, for everyone's reminder, is being offered at a price of $1 per token, and the sale will end at the end of this calendar year. Okay, let's move on to the presentation and talk more specifically about the SPIF. Okay, great. Okay, so first I want to tell you a little bit about just insurance generally at the Sun Exchange. How does insurance play a role in the solar projects at Sun Exchange? First, let me talk about the risks that we currently insure with regular insurance companies, and then I'm going to pass it over to Thierry again and have him explain to you what other types of risks we might experience on the solar projects and why do it with a SPIF and why it's so important. So the solar projects that we are building, that we're operating right now and that we'll do in the future will all be insured against various types of risks that are typical to solar projects wherever they are, whether they're in developed countries or developing countries. Some of those are just physical damage to the equipment, fire, earthquakes, all kinds of natural phenomena can damage the equipment. As you know, it's very unfortunate to say, but theft is a very big issue in some communities where we operate, and so we insure the equipment fully for theft. We also insure for third-party liability, and basically what this means is that if somebody, let's say if there's a storm and the wind is very strong and one of the panels flies off the roof and hits damages someone's car, or someone gets injured for whatever reason, the insurance company will cover us for any claims that are made by other people in relation to the solar project. Finally, there's a short-term business interruption. This is basically the revenues from the solar projects are insured for a period of generally up to 3 months. If there's some problem related to, for example, a fire, and we lose revenues on the project, then the insurance company will cover some of that. But that's not a long-term coverage, and it's not a coverage of a problem with the off-taker having not paying his bills. It's really related to some of these natural disasters and so on. So hopefully you understand that. These are risks that we generally insure with companies like AIG and Old Mutual and other traditional insurance companies, third parties. So Thierry, maybe you can say a little bit about the other types of risks that we're experiencing and how we're proposing to insure against them.
Yes, thanks. So in the life of the solar project, which is, as you know, around 20 years, a lot of things can happen to the business, and we can do all the underwriting and all the due diligence we want over that period of time. There may be some issue with the off-taker, the company that is using the solar panels. So we felt there was some risk to the cell owners that we wanted to reduce. So this is really where the SPIFs comes in play to cover for bankruptcy of the consumer that simply would stop paying, and maybe the facility itself would not be used anymore. In that case, what we can do, we still own the cells, and we can take the cells and relocate them to another project, or maybe have another facility nearby using it. But all these things require work and cost something. So the SPIF will cover the cost of either relocating or maybe having a new lease with a new customer. And that would be that would be very helpful and could cover the entire Sun Exchange solar portfolio. Larry, you want to go back?
Okay, that's great. Thanks a lot, Thierry. Thierry is an insurance expert, of course, and the two of us have spent a lot of time trying to put together some mathematical models that predict, what sort of defaults we might, experience, and how to, financially cover those with the economics of the SPIF. And we think that, probably on average, the portfolio might, in an unfortunate, if things really get hairy, we might experience as much as 10% default rate. And the SPIF is designed with the premium amounts that we collect and each earned on the cash collateral, as well as the stake token sales, to more than cover for that sort of stressed default scenario. Okay, well, we've already taken about 15 minutes, so I have a fairly detailed presentation to go through in the next 10 minutes. I'm going to go through it pretty fast. We're going to put a link to the presentation up after the call. Everyone is free to, to read it more slowly later on, and email us or contact us in the Telegram chat with questions. So, as I mentioned before, the SPIF is going to be implemented once we hit this $5.4 million financial threshold on the token sale. And the money that we're going to raise before creating the SPIF is really going to be used to fund the Sun Exchange business development, to hire more developers. We already have a team of 6 developers, but we'll hire more, and this money will help us to create the infrastructure that supports the SunX token and the SPIF itself. So what is the purpose of the SPIF? Thierry already told you, but the SPIF is designed to protect against solar project defaults. These are risks that really cannot be hedged, cannot be insured against using traditional insurance companies, and so we have created this special revolutionary token product to fulfill a specific need for building solar projects on using the Sun Exchange platform in developing countries where some of those default risks can be pretty high. The SPIF can insure up to 20% of each project's construction costs, but it's also subject to a cap of 10% of the total portfolio. The purpose of this is, to not completely remove risk and to be on 100% of the project cost, to be able to insure lots of projects rather than just a few, and to make sure that, if we've got one particularly large project in the portfolio and a lot of smaller ones, that larger one doesn't eat up all of the insurance coverage and compromise the coverage on some of the smaller projects. Now, the SPIF is designed very conservatively to be safer than any insurance company, because as you probably know, insurance companies, will keep a certain amount of cash in reserves, or they'll invest in safe securities, but they don't cover 100% of what they're insuring. But the SPIF is very conservatively designed to 100% cash collateralize the risks that it's insuring. That's a first layer of defense. That cash, or those U.S. Treasury bonds that we buy, will be the first layer of defense. But there are other layers of defense in the form of staked SunX tokens and SunX tokens in reserve that can additionally support the insurance of these projects, and also help to top up the fund if it gets used to settle any claims on the solar project defaults. So as I mentioned, the first line of defense is the cash collateral. And the cash collateral really comes from 3 places. First, it comes from that 20% of the proceeds of the token sale after the $5.4 million threshold. Another source of funding for the SPIF cash collateral is interest that's earned on that cash pool. And finally, there's an insurance premium that each solar project needs to pay monthly to buy the insurance to be covered. And this insurance premium month by month gets added to the cash collateral and helps to keep the cash collateral, to increase it, or at least to help top it back up if there are claims. We have done a bit of mathematical modeling, and we believe that even just the insurance premium alone over time should be enough to cover all the risks that we expect. But if that isn't enough, we also have the earned interest and the base collateral itself to support. Now, in addition to this cash collateral that I just spoke about, we also have, we are able to take advantage of the stake tokens to support payment of claims. There are really two layers of token defense. The first layer is these bonus tokens, which, if they're not used, will get paid out to the stake tokens at the end of their staking period. What the Sun Exchange will do is reserve these tokens, take these tokens out of its general pool of reserves, and put them in a separate Ethereum address, and earmark them as bonus tokens to be paid out in future to the token stakers. But if there's a claim that needs to get paid, then pro rata, some of those bonus tokens will be taken out of the Ethereum address and sold by the Sun Exchange in the secondary market, if one exists, to raise cash and put that back into the cash collateral pool. Now, if all those bonus tokens that have been staked for the stakers get used up, we can then go to the second line of token defense, and that second line is the stake tokens themselves. So when you stake a SunX token on the SPIF, you are taking a risk that if the claims during the time that you stake those tokens exceed the amount of the bonus tokens, then you may lose some of your stake tokens. And just like the bonus tokens, the Sun Exchange will take those stake tokens and sell them in the secondary market, raise cash, and top up the SPIF. This is for the purpose of maintaining that cash collateral pool that can provide ongoing protection for the solar projects over a course of a very long time, 20 years or longer. So how do you stake SunX tokens on the SPIF? Well, it's a pretty simple process. For each project individually, as that project financing is finished and announced by the Sun Exchange, we will announce to everyone the staking opportunity. So it'll be the amount of tokens that you can stake, the timing, when you can start offering to stake them, when we will make a decision about staking them, and all that will be laid out on our website and in emails and on the Telegram channel. Then, for a certain period of time, it might be 24 hours or 48 hours, the SunX holders will submit their staking offers on our website, including the Ethereum address in which the SunX tokens are located. We will then announce the end of the staking offer, and then the Sun Exchange will check the balances of those tokens in the smart contracts, in the Ethereum wallet addresses, and begin to allocate the staking opportunities to the people who have offered their tokens for staking. Generally, it'll be on a first-come, first-served basis, up to the amount that we've announced, but we will give priority to people who have already staked their tokens and want to restake them. So how do you get paid? What are the rewards for staking your tokens on the SPIF? Okay, so when you stake your tokens at the beginning, you're going to earn two types of rewards in SunX. And if there are no write-downs, no claims, you will earn up to 20% return, annual return. Actually, since it's a 13-month period, you'll earn 22% actually of rewards paid out in SunX tokens. Now, when the stakes are made, the Sun Exchange will take out of its reserves some tokens. Some will be called rewards tokens, and some will be called bonus tokens. The rewards tokens get paid out at the end of each month, 13 times. And at the end of the staking period, you'll get your whatever stake tokens you have left paid back to you, as well as any bonus tokens which are available. So there are some detailed examples of how a project gets insured and how a claims process works, and I don't think we have enough time to go through these examples in great detail, but again, These examples are in the presentation, and I encourage you to please look at them and ask questions later if you have them, or during the Q&A session afterwards. But basically, each project, as I said before, can be insured up to 20%, capped at 10% of the total SPIF fiat currency collateral value. And although the value of the solar projects will depreciate over time, of course, the insurance limit will not be lowered. So actually, as a percentage of the market value of the solar projects, the value of the insurance, the coverage, will represent a larger and larger portion of the market value of the projects. A claim is made by either the solar cell owners or the Sun Exchange on their behalf, and we'll have a voting process. Let's say the off-taker, the energy consumer, stops paying his bills for 3 months, and we decide it's time to make a claim to the SPIF. Exchange might write up a proposal and send that out to all the solar cell owners. The solar cell owners then have the opportunity to democratically vote whether that is a good proposal or they want to change the proposal. We can have multiple revotes. When we get a majority of the solar cell owners to agree that this is the type of claim that they would like to make, then the Sun Exchange will do an investigation into the facts and then either approve or deny the claim. Now, if the solar cell owners feel that the Sun Exchange has made a bad decision, they may take that decision to arbitration, and we will respect the decision of an arbitrator. Once that claim is approved, then basically we will pay the claim out of the cash collateral that I spoke before, and there will also be a process to take the stake tokens, the bonus tokens, and to convert those into fiat currency to top up the SPIF collateral pool. And that is the end of my presentation. Please take some time to look at the legal disclaimer too, because there are some important risks and caveats to all the things that I've said. This is, of course, a plan and something that we need to build in future. And there are certainly risks that the plan may change, or that it won't be implemented as as you expect it to be. So please be sure that you understand this when you enter into this sort of purchase. At that, I think I'll stop and allow Barrett to open the floor up for questions and answers. And both Thierry and I will be available to answer your questions. Thank you very much.
Okay, guys, well, thank you very much, Larry and Thierry, for that. Seems we only got questions there. First one is for Thierry. It's from Katie, and she says, can you speak to how other solar lenders and PPA providers around the world handle this customer-tenant default risk? There are mature distributed solar finance companies in the US and beyond who are managing this somehow. If the SPIF is in place, how do we gain comfort that Sun Exchange won't choose to pursue riskier projects?
Yes, and I'll answer the second one first. Like, will the Sun Exchange be induced to pursue riskier project? And I really don't think so, because a default of a company over 20 years really is something that cannot be evaluated up front. So I would still expect the Sun Exchange to do the thoroughest job at underwriting these customers, so that we do not have defaults at least for a few years after they are put in place. As you know, what happens after a few years can vary widely. based on the situation, the economic situation, the country situation. So I really do not expect the Sun Exchange to take on riskier projects because of the SPIF. In terms of what other people are doing, there is a number of different insurance that that lenders can use. The cost is usually forwarded to the actual customer. And somehow this is what we're doing also with the premium that that every project will pay into the SPIF. So the premium's really calculated so that it covers the insurance. The SPIF comes as a reserve fund. So as you know, insurance is what it is, and sometimes things happen that needs to be covered. So I hope that answers the question that was asked. Barrett?
The next question was, it's well known that the US currency is going down. Why are we using the US currency? Perhaps Larry would like to take that question. Larry?
Okay. Yeah, there we go. Well, most of the time, solar equipment is purchased and sold denominated in U.S. currency. Even if we're buying solar equipment for, let's say, South Africa or from Moldova, the original cost of the equipment is denominated in dollars, and then it's translated into a local currency. So we believe that the best hedge, the best matchup of currency and equipment prices is done in U.S. dollars. Now, having said that, if you read in detail in the white paper what flexibilities the SPIF has with respect to currency, it does say clearly that we may invest some of the collateral, the cash collateral, in the project currencies. Why would we do that? Well, for example, some of the labor expenses might be denominated in local currency, et cetera. And so we might want to hedge some of that currency risk by some of those expenses by having some cash coverage through the local currency like South African Rand or euros or whatever we may need. But predominantly, we think that the risks are in U.S. dollars, and we want to have a good match of the collateral denominations with the equipment denominations. That's the reason.
Great. Well, thank you very much. There's no other questions. I think that's pretty much it. Thank you both, Larry and Thierry, for joining us and for explaining the SPIF for all our community members, and thank you everyone else who has joined us.
Thank you very much, everyone. Please take a look at the presentation in more detail, and please pose any questions you have up on the Telegram chat or email the team at Sun Exchange, and we'll get back to you quickly with answers.
Thank you very much.
I'll post the link for this presentation for you guys.
Wonderful. Okay, thank you very much. Have a good evening.
Goodbye.